Welcome to the Wealth Rebels show. I'm your resident wealth rebel, Emma Wright, and I am bringing you today the very wonderful Adam Brewer. Adam Brewer is our resident expert on investment management, and a really dear friend of mine. And I just can't wait to dive into today. Every time we have a conversation, Adam, it just blows my mind. I learn so much. And I just want to say, before we dive into this conversation, I was just saying to you, Adam, the little nuggets that we share in these conversations, whether it be on this, forum in public, on whether it was on the podcast in the past, whether it's been on the YouTube channel now where it is today, the feedback that I get, or it's in the community, the Star Portal, is that the knowledge that you share and that we share collectively is just really appreciated because some of the things that we know we take for granted, right? I just spoke like you then. We take for granted. Honestly, we think that we understand these terms and we sometimes forget, you know, people don't always understand the basics. And I really want to kind of take things back a little bit today and talk about some of the basics. I have a little bit of a to-do list. I always have to come prepared with things I want to ask you about, Adam, hear from you today, about what's going on with Trump. Want to dive more into what asset allocation is. We talked about risk management, what even investment management is, because that for me is the underlier for what you do for your clients, and then kind of like remind people how they can reach out to you if they are looking for an investment manager. If they have wealth, I would recommend anyone that's listening to this that you need to speak to Adam 100%. You came into my life. When was it? When did I move to Devon? And then, so I had Harry 2018. So I think I met you in 2020. I must have met you in 2019, 2020. So, your knowledge has always blown me away. And we've always just, even though at times we've maybe been classed as rivals, I don't see that ever. We've always been really supportive and collaborative and seen the value that we've always added from different sides of the fence, as whether it was financial advisor, financial coach to investment manager. So, firstly, waffling there, welcome back to the show, Adam.
Thank you. Thank you. It's good to be back. Yeah. Thanks for keeping inviting me. It's great.
And
Yeah,
I won't
excellent.
stop. I really won't stop because, and this is the important thing, even though we get the knowledge and we get an update, things are so fast paced and fast moving in the financial space. And this is why I want to bring you back every 3 months, because I think if we do it every month, we're saying that we need to be looking at the markets all the time. And one of the biggest things that you talk about is, it's a buy and hold strategy to even hold our nerve in a downward market. There's opportunities to invest when markets are going down and all of those things. So I think 3 months is a really, really perfect time to have you coming back and giving us that quarterly update, even though things are so fast paced. So firstly, Adam, let's just dive in a little bit into what's going on in the financial markets, because I am getting asked so much about what the heck is Trump doing? What do you think about what's happening in the US and how that's influencing the financial markets? I'd love to just kind of get a little bit of a snippet into that from you today.
Excellent. Yeah. So the last time we spoke, um, we did talk about expectations and return expectations and volatility expectations. And in that, we said that in an average year, the market falls 15% from its high point to its low point, roughly. Um, and and it has. It just did. And it's not like we predicted anything. That wasn't a prediction. That was just an expectation. Um, so I think that was very timely, but we should always have that in our minds that this can and will happen. So 10% falls in the market happen, once every other year, maybe once a year, really. 20% falls, I think, once every, say, 4 or 5 years. And anything more than 20% you normally need to have a recession. So if there's not a recession, then it might be an event-driven fall, which you can take advantage of. If a recession, potentially it could go down further to 30% off its high, or 40% off its high, or in 2008, 50% off its high. So you always have to have that in your mind, and you need to, at the point of when it's happening, because these things are quite hard to predict, to then think about, will this push into recession or not? So the question at the moment is, will this push into recession? Most investment banks, most strategists, and ourselves, we upped it to about 45% chance of recession. That was kind of the peak of when everything was going on before that last Wednesday, when the market had a very, very good day. So the likely outcome that it wasn't a recession, it wasn't going to go into recession. But that's, again, these are just, you've got to put a number on it and do your best, really. So even though these things are quite fast moving, as soon as you write something, it's out of date. As soon as you read something, it's out of date. This last 10 days or a couple of weeks has been pretty manic. And the best advice has been just to sit back and just take it all in, read what you can, analyze what you can, but know that this could change very, very quickly in the next hour. And you can see when, Trump tweeted on his Truth Social, or I'm not on that, but this is a good time to buy. And then 3 minutes later, he said that he's delaying it for 90 days. And then the market went up, say 10% in that day. You just can't predict these things when it's coming from some guy's head. You can have an idea, you could think this is what he's going to do, but you don't know when. So it's very, very difficult, and I don't think anyone should try. And in that sense, they shouldn't try to time these things, but also they shouldn't let it become an emotional problem or cause them anxiety, because it's just going to happen. These things are going to happen. There's nothing you can do about it. The most important thing when these things are happening, we can talk about tariffs and stuff in a sec, but the most important things when these are happening, we've always heard this: if you miss the best 10 days in the decade, you've made 30% of what you would make if you just left your money in, right? So you don't want to miss these best days. That best day was a 10% day. These best days, and I think we've said this before, these best days happen or occur around the worst days, right? So you just, when things are really volatile, you just shouldn't take your money out. It just doesn't work. And you can look online, you can see a load of charts. If you just look on, if you miss the best 10 days, you miss the best 20 days, or you miss one day a year, the best day a year, all this stuff, and then think about when those best days turn up. And so that's really important. Firstly, to hold your nerve, to know that these things can move quite quickly. And if you've got, and we talk about this short-term noise and why we do this every quarter, but you keep like one eye on the president and what's going on, but you have to keep one eye a year into the future, at least, if not 2-3 years really into the future. So you're kind of looking at both. And you don't necessarily, you want to see if the short term is going to change the long term, because the long term for us, or for you, or for anyone, is, what do I need this money to do for me in the future? Does it need to grow, or do I need it in a year's time and actually it needs to be in cash because I need to spend it and I can't afford things to be volatile? So to go on asset allocation slightly, I'm just going to mention it and then I'll go back to Trump, but asset allocation is very important for your time horizon. So if your time horizon is when you are likely to need that money, and asset allocation hopefully means that when you do need that money is still worth £1. It's not worth 70p. Yeah. So you don't want to have to take out your money on April the 4th when the market was 15% down on that exact day. So We just need to be aware of when we need the money. And if you don't need the money, you can comfort yourself with saying, well, actually, I don't need it, so it's a paper loss. And it's exactly the same point as if someone knocked on your house and said, and you think your house is worth 200 grand. Someone knocked at your door and said, I'll give you 100 grand for your house. Well, at that point in time, your house is worth 100 grand. And you think, God, I've lost 50% on my house, right? But you haven't. It's just what someone will give it to you. And the market is giving you a price. It's giving you, you can sell your whole portfolio, all your investments for this price. Yes, it's 30% down from what you wanted, but this is the price I'm offering you. You don't have to take it. It's a quote. You don't have to take that quote. It's really really important that. So just think about that guy knocking on your door.
Love that. And I love that so much, Adam, because what you've just said is where, we just see the quotes in the market, really. I mean, trading is happening, but fundamentally, you're only a loser if you're a forced seller. And it's making sure that you're not a forced seller at the wrong times. And also, if one of your companies goes bust in your portfolio and you have that one company, one of the investments that you have loses all of its money, yes. But the chances of that in a portfolio when it's made up of lots of companies is way minimal, right? So this is why we talk about holding a portfolio of assets to create that risk management so that you have some diversification. But what's interesting, there's a couple of things that you said there, Adam, that I want to reflect on from my kind of higher perspective, in a different perspective of my new way of thinking in these ways. Is number one, you got it right? You made a call last time and you said 15% loss, and it happened. And everyone could be going, wow, amazing. Adam can predict the market. It's not a prediction, it's an expectation. We just have expectations based on what's happened in the past. So, you said you have a moment on the present, you're looking to the future, but we also have an eye on the past and what's happened to see the trends, to see how things react. And then number two, it feels at the minute somebody's playing games with the market, like it's fun, right? And they know that they've got a lot of power and they can play games and they can say one thing and then say something else. And a lot for a really long time, it's been a bit of a currency war around the world. It has been a game of whoever's president or whoever's a leader around the world playing games, and the financial markets feels a little bit like a game. And I think that can be what puts people off investing. And so what I want to get from you today is, whilst all this noise is happening, all this, people are blowing their trumpets. Trump, it's quite great. He's got the most interesting name, and we're seeing a playing of games by powers of be. We have to do what is right for our financial future, because this is our financial future. We are living longer. So we do have a longer time horizon. Many of us aren't going to retire at 60. I mean, it just doesn't happen anymore, we're all, a lot of people are now entrepreneurs. They love what they do. Our investments create financial freedom and sovereignty, and the choice to work one day in the future, and seeing things differently now is really important. We have a greater time horizon, and so for me it's understanding how the asset allocation can help us to get comfortable with investing, and then, like you say, learning not to react to the games, but look at what we're actually putting our money into. What are the companies? Having more of an awareness of the investments that we buy, not just going down a trend, but actually thinking, in this present moment, if I had 10 companies or 20 companies, what company would I buy and why would I buy it? Taking that sovereignty back, because I think a lot of us have lost that investment interest, because for a long time we've just given it away. Someone else can do it. I'm just going to go and work. And we're realizing now that we want to learn more. And it doesn't mean that we don't have someone like you doing it for us. It just means that we have greater confidence, greater knowledge, and a real understanding of why. Sometimes people sit down, and I had this as a financial advisor, they sit down and they don't actually know what even asset allocation is. They don't know why they've got 50% bonds versus 50% equity, or maybe why they need to have cash. It's just like, well, my advisor just told me to keep 20 grand in cash because that's a good amount. And my portfolio, yeah, it's balanced. I think balanced is all right because I'm pretty balanced. So I'm going Dave Narvin there. No, not okay, not acceptable. You do not just do what kind of you are told to do. You should be doing it because it's been really explained. You fully understand it. You know why you're keeping cash because it means that you are in the market. And if there was a downturn of a recession, it could take a lot longer for that recovery to happen if there is more than the 20% drop. Let's have these real conversations of understanding the market because, and then yes, you have an Adam that is sat there looking at the numbers, looking at whether it is a 45% chance of a recession and what should we be buying in this moment? What should we be adding to our portfolio in these times and maybe scaling back on some positions? You know, that is really the value that you bring. So let's go a little bit deeper, Adam. Let's just go really deeper because I think I really want people to understand what's happened, why would we have asset allocation? What is asset allocation and how can people get really confident, even if they're doing it themselves, and they're starting out to invest for the first time, what is asset allocation to you and how can we use it to enhance our um, experience and confidence to get invested and kind of ignore that noise, not
Yeah.
ignore it fully, having the eye on it, but not allowing us to feel stressed that we need to react.
Yeah, yeah, and asset allocation is looking at the long term and what's right for you long term. And when I say long term, I mean 10 years. What is right for you? Um, Asset allocation, getting the structure right at the beginning is the most important thing that we can do. And then when things like this happen in the last couple of weeks, that's when we sort of tweak things. We can just tweak it here, there, on the margin, depending on how we feel about ourselves and how we feel about the volatility, but also how we feel about the investments and where to take advantage of them when things do increase. Because when markets fall 10%, in the next 12 months after that point, the average return or the median return of the market is about 15%. So when you see a 10% fall, you're more likely to see an increase. And it's think about it this way: asset allocation, getting the structure right at the beginning, is like planting the plant, and then when these things happen, it's pruning little bits here and there, trimming the little bits and doing that. So you don't trim when you haven't got a plant. You've got to get the plant there first, right? And get the right plant. um
Yeah.
I'm not a gardener.
I love that. No, I
um
love that analogy because it helps. And one thing you've said two words that, to my mind, people may not understand. What is a margin? A margin is when you say, okay, I'm going to have 50% equity. Equity is stocks and shares. You own the shares in a company. That's an equity. You have 50% stocks and shares, but your margin, you can go up to 60%. Yeah, that's the margin of growth that your portfolio is allowed to have within a given risk tolerance because there are set risk tolerances that you're allowed to abide by. So when someone comes to see me, maybe in my old role, my old hat as a financial advisor, and this happens for you because you also do this when you see your investment management clients, they'd come to see me, I would go, do a really good job of understanding their attitude to risk. And we talked about this before, their capacity for loss, all the things that would go for me to recommending a balanced portfolio that would be 50% equities, 50% bonds. And this is very generic asset allocation because there is way more assets in there. A cash is an asset, right? This pen is an asset because it's helping me to write. Okay, assets are physical things that we can own, but the main kind of crux of a portfolio bonds and shares, right? And within that, there's lots more. But fundamentally, therefore, the margin is that I've recommended Adam, my client is balanced. You're going to construct and plant the seeds of a balanced portfolio, and it'll be 50-50 when it's set up. But then it's going to change over time, and you have that allowance to make those kind of margins, those tweaks, rebalance your portfolio. Volatility is how much it moves up and down every day. You know, how much your portfolio is going to move up and down in value. You know, if you put 100 grand in, goes down to 90 grand, it's dropped. That's the day, like that's the volatility. It's the ups and downs of the prices. The prices make up your overall portfolio. So, and I just think that's a wonderful way for you to say it. You know, you're planting that seed based on what it is that you need long term from your money. And if you want to have a long term outlook, you've got 10 years or longer, you're going to want to make sure you are risk on. What does that mean to you when I say risk on, you know, in terms of asset allocation?
Yeah, yeah. It's interesting, isn't it? Because if there's three things we spoke about before, is that what do you want to achieve? So that's one thing, your objectives, your capacity for loss, which is can your financials and your sort of time horizon stand to see any kind of volatility? Um, and also your attitude to risk, which is how you feel about volatility, which is the driver actually of a lot of knee-jerk reactions when markets fall, or you get a lot of fear, or when markets go up, you get greedy and you put more money in at the wrong time. So those three things really, and you can look at. I mean, we look at like questionnaires. We give people questionnaires, and they tick a load of boxes, and to see how they feel, we come out with a score out of 100. And your score might be 60 out of 100, and you think, okay, well, roughly we'll put it in 60% equity and 40% other things. But I think getting that right at the beginning, so getting your objective is, write that down. Right, what do you need this money to do? Is it for retirement? Is it because you want to move house in 2 years' time? And if you're moving house in 2 years' time, you need the money in 2 years' time, so you can't take as much risk. So you have to have a lower risk. And if you don't need it for 10 years, 20 years' time, you can take a lot higher risk, because you do not want the issue of when you want to move house, buy a new house. You don't want the market to fall at that exact date and then having to take the money out, of forced seller, as you say, forced seller to take the money out at that point. So that's where we get it. Now think about asset allocation and the difference between, it's almost just high risk, low risk. Okay, something that's volatile, something that isn't volatile. So something that isn't volatile, you can just say it's cash, because it's just easier. Everyone understands cash. You're getting like your 4% cash, 4% return every year in your cash. And then your equities, which is your higher risk part, will get you, well, on average, it's been about 10% but a year, but it can be quite volatile. So the more low risk you have, the more cash you have in your proportions. So you could start with 50-50, but the more cash you have, the more your returns every year are going to converge to zero. So if you've got zero, and I'll just say, to make things clear, if you've got no cash, right, and you've got all equity, that's a high risk portfolio. Which, don't be scared about the word high risk. It's just an asset allocation thing.
But we're talking about volatility, aren't we here?
So yeah, so that's going to cause you to be exactly in line with the market. If markets fall, you're going to fall. If markets fall 20%, you're going to fall 20%. If markets go up 20%, you're going to make 20%.
Do you
Okay.
think risk is a good word for it?
No,
I
no,
think it's the
I
worst
don't.
word because
It's terrible.
there's risk in cash. And like you say, inflation, which is an awful word, we should rename the word inflation because we think actually, oh yeah, we've got 2% a year, we're doing really well because we're in line with Bank of England target of inflation. It's actually a devaluing of your currency. It means your pound is losing money constantly. Constantly. If you've got a pound, it's literally just being chipped away at. Like
Yeah.
if you were to scrape bits of it off and you end up with like none of it left. It's just like, right?
Yeah,
That's it.
exactly,
That's
exactly.
inflation. So I think risk is a terrible
Well,
word.
actually, do you know what? I agree with that, but actually, I was thinking about it's a different, it's a terrible word for a different reason
Yeah, I love
because
your reason though. You always
because
enlighten me,
people get
Adam.
scared.
But
It risk means bad, right?
yes,
And
yeah.
actually, so and one
Oh,
question
does
you
it
always
though? Because I'm a risk taker
well, yeah.
by
So that's what I
life.
was going to say. So, how do you feel about risk? This is attitude to
Yeah,
risk. Like, how is your attitude towards that risk? When you hear the word risk, do you think it's an opportunity, or do you think it's a threat? Do you think it's, do you think it's a good thing or a bad thing? And some people do think it's an opportunity, you know.
yeah.
So, but I don't think risk is
Love that,
a good
Adam.
way of saying it because a lot of people come out and say, "Oh, well, I'll just be medium risk," you know, because it's not too hot, it's not too cold, it's
Yeah,
just in the middle. That's where sort of most people, want to be. It's like
middle
when
of
you go
the
to,
road.
well, when you go into Starbucks and they give you three drinks and you pick the one in the middle.
I'm always a
Um,
tall actually in Starbucks. I'm tall. I'd rather have multiple coffees at a smaller amount, But
right,
yeah,
yeah.
I'm not a long drinker in coffee. I'm
Well,
sure.
I don't know the names. I don't know the names at all. Like Venti, is that a large one or something? I don't know.
Yeah, I'm short in the market in no, actually, because it's a tool. It doesn't
Is it?
make sense. Starbucks, your drinking conventions do not make sense to my trading analogies here. But
Yeah.
100% what you've just said is it just really resonates with me. How do we feel about risk in itself? Is that, we think risk is bad. Risk is just yeah, how do we feel about risk? But maybe it's just not a great word for describing what we are experiencing with a high risk portfolio because it's not necessarily high risk. It's like high volatility, there's different things that
It's
are,
higher than something else. It's higher than medium, right? But this is the thing, because when people come into investing, there a lot of people are new to it and they don't want to suddenly, jump in with 2 feet, do they? Like, they
yeah.
want to sort of dip their toes in. So that's why they tend to start lower and they hear the word risk and they think, I don't want to be high risk. I could lose all my money.
But then they're
Right.
entrepreneurs, maybe running a business where they're taking so much risk, but they're comfortable with their own company, but
Mm.
not comfortable with a portfolio of other more established companies. And
Well,
that's interesting, isn't it?
and that goes into the volatility of things because if you think about a company and any company, I guess
Mm.
the dividends are probably the most consistent
Stable,
part
yeah,
of the
more
business,
stabilizing.
stable part of the business.
Mhm.
Then your earnings that come out the bottom, um, and then your revenues, and then your maybe your share price, depending on your fixed costs and stuff. But then your share price. So your share price is doing this, but your
Yeah.
dividends might be quite smooth. So when people running their own business, they are taking a lot of risk, but they don't see the volatility in the business because they don't see the value of the business every second of every day.
Mm.
It's the same as if you're renting out a house. You see the income coming in and you think it's quite stable. Um, if there's a void and it's not been rented out, well, the value goes right down, right? But you don't see that in the value of the house. And same
Yeah.
with the business. So when you're running a business, you see your earnings and your dividends and things,
And
and
you've
and
worked
they're fairly
hard
stable.
to make your money. So when you give it away, and it feels like you are giving your money away, right? When you invest, you're giving it away to somebody else. And they see that somebody else, not always as Apple, you bought Apple. Let's just pick on Apple shares. I've just bought Apple shares. They actually see it as giving it away to Adam. Giving it away to Adam. They don't sometimes see where it's actually being put to and how it's being put to work. And so, you've worked hard to make this money, you just don't want to lose it. And so, therefore, it is really important to understand what risk is and understand how you can manage your own expectations, how you can get comfortable with taking the right level of risk for you so that you are a risk taker. Whatever level of risk you take, you are a risk taker. Let's accept this. Let's just accept that life is one big risk, game of risk, right? But fundamentally, how do we tweak and adjust what we invest our money into, how much cash, how much stock, you know, how many bonds, what are bonds, it'd be good to understand all of these terms to really kind of reflect where we are in our life. And
Yeah.
I do think the more that we get comfortable with it, we won't be first time investors at 40. I'm 42 and I've been investing a long time because of the nature of my job. Started trading from a really young age, right? So I've always been in investments. That's not normal. Most people go through life, they don't really see themselves as an investor, Adam, because they don't see their pensions as an investment because it's just an auto enrollment and they take no interest in what they're putting their money into. They just go with the whatever it is, the lifestyle strategy. So what we're now seeing, which is so good, Adam, is that young people, as soon as they're leaving university or before, are actually taking an active interest in learning about investing so that they can get really comfortable. So if they are putting £50 a month away for their financial future, they're all in equity because A, they don't need it, B, they understand it. And then, and they're kind of becoming investors at a really profound, impactful time. And because I know we've talked about this in the past, right? How you can become that millionaire by putting literally a small amount of money away and earning, you know, you know, compound interest over time. It's profound. I've gone off on a tangent here, haven't
Yeah, but actually, you bring up a good point because if someone is putting in regular amounts, you actually want volatility,
I?
right? Because if you're putting in regular amounts, we talked about this pound cost averaging concept before that people can look up and see what it is. It's basically putting in the same pounds and pence every month, and when the market falls, you get more of the market, and when
Yeah,
the market's high, you get less of the market. So you're actually buying low automatically and selling high, but buying less when it's high automatically. So
yeah,
the volatility is very, very good for you.
yeah.
So in that concept, but actually, let's put some meat in the bones a little bit with. And let's just put out a default thing here. We can agree or disagree. I don't know if I agree with what I'm about to say, but we can just say, right? We can just do it. So the proportions of equity and low risk. So let's say your cash and your low risk and high risk. Sorry, low risk and high risk. Um, if you need it in a year, if you need all the money out in a year, 10% in high risk, 90% in low risk, right? And for every year you don't need the money, increase it by 10%. Let's just start as that as a default. I don't necessarily agree with this, but it's just something to think about to
It's
say,
really
right,
helpful though,
I
isn't
don't
it?
need it for
Give
7 years.
something to work with,
Yeah,
to say, you know what, do you know what, my take on it is if you need it in a year, just keep it in cash because interest rates are pretty good right now. I always think
yeah,
about where interest rates are, the times you can get a really good interest rate. Is it worth even the 10% in a year?
yeah,
Then again, that is why it's a debate that you can have with yourself
yeah.
on that knowledge. And that's why you've just said, this is just a template. It's good to give ourselves these little benchmarks and templates to say, right, okay. And so it's cash, not bonds.
I was making it easy. but
Yeah,
but
because
but
what
but,
is a
but
bond? A
you
bond is when you lend money to governments and companies. So instead of buying the share, instead of giving £10,000 to a company to become a shareholder, you give £10,000 to a company to lend it the money on a fixed term, and they agree to pay you a fixed amount back. And that's why it's often known as fixed interest as well. It's not always fixed. Bonds aren't always fixed. We're just being, again, very generic here, but it helps you to understand the difference between a bond and an equity. And the reason why it's more risky, the stock price is completely and utterly usually dependent on kind of predictions, expectations, and all of the kind of things we have no idea really what's going to happen. We can make predictions and expectations, but with the bond market, you know when you're going to get your money back, you know the time horizon, you know the coupons. The risk therefore is if they don't pay.
It's
Uh,
contractual.
and then, yes, they are traded. and the kind of the valuation of bonds is influenced by interest rate movements. Now, not going to go into that. That's getting more complicated, but it just shows you the differential in the risk. So bonds are less risky. You'd expect to get a lower return. Stock market is more risky, i.e., more volatile, more uncertain, but higher potential, higher expected returns from that. So therefore, when we're we're taking risk, looking at asset allocation, we can go cash versus the stock market, which I actually think is a better way of doing it because I think bonds are an interesting asset. But I think bonds have their place in portfolios when done correctly by an investment manager because you're looking then at the actual bond itself as an actual investment versus the stock equivalent. Oh, is it going to be a good investment to go and buy the bond of that company versus the stock of that company? That's really interesting for me because I think when we touched at that in the Star Portal last month when we talked about the Star Portal, we actually kind of went quite deep on is it a really good time to have the bonds generally versus equity because of where we thought the market could be moving, and we thought, if we're going to go into risk assets, that actually the stock market is better. So let me get your take on that. The things that I've just kind of touched on there.
Yeah. So I think a good way to start is to look at, you can get 4% on cash. Let's put some numbers out there.
Yeah,
4% on cash.
yeah,
Take a little bit more risk and buy a government bond, and you get 4.5%.
yeah.
A little bit more risk and you lend your money to a company, so it's a corporate bond, so
Corporate
it's still
bonds.
high
Yeah,
quality. Let's say you get 5% on that, or maybe 5.5. You lend it to a slightly riskier one, you can get, say, 7%, and you can lend it to, I mean, I know this because I spoke to a company called B&M. People might have known it
I went to
lately.
B&M last night. I kid you not. I never go to freaking B&Ms. Again, this is I'm very spiritual. I'm like the universe. I went to B&Ms to buy a mirror for my business. Anyway, carry
Yeah,
on.
well, they issued a bond, I think in January, February time, about 8% or a bit over 8%. So you can see the riskier the business, and you can get bonds that are, paying over 10%, and you can go to emerging markets and pay. So actually, a bond isn't just cash. You can get cash plus, but you take the risk, and the risk
Yeah.
mostly is credit risk. So the risk of that business going
Cash
bust, right?
plus the risk.
Yeah,
Yeah,
yeah.
I get you.
So that's one thing to look at, and and this sort of spectrum. So we look at like bonds and then equity, but within each, you have such a spectrum of low risk to high risk, investments in each bucket. We won't go into that now, um,
But I
but
think that's a great analogy. What you've just that's really helps you understand, isn't it? That you've got cash, then you've got government bonds that are a little bit more risky than cash. So they've got to pay even a really good government has to pay 4.5%, and it's the term, isn't it, as well? The cash has to be a term. Instant access cash is going to be maybe not 4%, right? In your current account. So, because people will be thinking, oh, these kind of terms. So we're trying to compare apples with apples or the same sort of fruit, the same sort of kind of family, so we can really understand how you would expect to get paid because you're getting paid by the company for the risk that you're taking for lending them that money. And so B&M need to pay you a 4% premium on cash versus a 5% might be M&S. I don't know, right?
yeah,
A better name. You
and
might know
they've got to
that
pay you
actually.
first, right? Yeah, they've got to pay you first. So B&M have to pay that bond and the bondholders before they pay the dividend.
Yes.
Right?
Great
So that's why it's
analogy
less
here.
risk, because when B&M get all the money in and they make, say, like, I don't know, 5 billion of revenue or something,
Mm.
um, when that comes in, they allocate that, and that has to go to the bondholders first before anything,
Yeah.
right?
Yes.
A few expenses at the beginning, and then the bondholders, and then a few other things, and then the dividends at the end if they've got it, right?
Yeah.
Um, So that's why it's less risk. You're higher up the capital structure. They
Yeah.
they call it that capital structure thing. Um, but it is a spectrum. The other thing in bonds you can do is you can, rather than saying I'm going to buy a bond and it's going to pay me my money back, it's going to pay me interest every year and pay me my money back in say 2 years time, 3 years time, or 4 years time. You can actually push this out to 10 years time, to 20
Mhm.
years time, and you can push it out to, well, 100 years if it's available, right?
Yeah.
That is increasing your risk as well.
Yeah.
And it doesn't mean a bad thing. It doesn't mean a bad thing. It means that actually, if you buy a government bond in the UK that is going to mature in you know uh, in 50 years time, um, if interest rates fall, you're going to make a lot of money on that bond,
Yeah.
right? And that's all I say, because I think that's kind of as far as duration we want to push that. But so you've got, going back
Duration
to asset
being the
allocation.
time,
Yeah, exactly. Time to maturity. Yeah,
time to
roughly,
maturity. Mhm.
roughly. Yeah. Um, and but going back to our sort of low risk, high risk. So we'd said, right, if for every year you don't need it, you put in an extra 10% of equity. And you said, no, actually 1 year, leave it in cash. Actually, I'd say 3 years, don't invest. 3 years is a minimum. And actually, you could probably say 3 years. Anything over 3 years, so 4 years, you put in 10% equity. In 5 years, you need it in 5 years, you put in 20% equity. You need it in 13 years, that's when it would be 100% equity.
Yeah.
And so if everyone can use that as a kind of a gauge to say, well, that's where I'm going to start with it. So I need it in 7 years. So I'm going to have 40% equity or something in it and 60% other things. We could start there. And then you tweak that by saying, actually, how do I feel about the market? Am I a nervous person? Am I going to look at it every day? And then you probably need to bring it down. Or if you say, I'm never going to look at it, it's absolutely fine, I don't worry about it at all, you could probably tweak it up a little bit. So you're almost getting the starting position and then tweaking it, but tweaking your long-term goal rather than your short-term. But I want to caveat this with saying a lot of people never have a cliff edge taking all your money out. I mean, you're buying a house at some point, but you never say, right, in 10 years' time, I'm going to buy a house. You say, I want to buy a house in 4 years' time, which means in that point, you probably shouldn't be investing much in the market anyway. So
Yeah,
what
I
I'm
get
saying is
very,
most people
very
just don't have it.
twitchy about it. One thing that I do want to just touch on that's come to me, Adam, is, we're thinking here, people already have a lot of money. A lot of the people that I work with are building wealth. And so when I work with these formulas, I look at, their freedom number being how much you need to spend to live your life, right? My freedom number, for example, is 2,000 a month to pay my bills and live my life. I'm being kind. It's a quite a low
I've
number.
got 4 kids, so mine's a
I
bit higher.
always forget you've got 4 kids. Like,
Mine's a little higher.
okay, yeah, okay. Mine's a little bit higher too, but I'm just keeping it simple. Let's assume it's 2 grand for my freedom number, which is living my best life. Okay. Maybe not in today's inflation. And I want to talk to you about inflation, please, before we finish today. I've written it on my notebook. Then I flip. So this is like your asset allocation. I'm like taking your asset allocation into my model. I'm going to pinch you and add you into my methodology, and I'm going to credit you for this, by the way. Because then we go, right, okay, if it's 2,000 to live, I then need an emergency fund. And I call that the financial security number, which is actually an amount that's linked to your freedom number. And as a minimum, we should have 3 months. Usually people have nothing. We're starting out in life, right? And we're earning. So that's why we're so heavily reliable on our income and our earnings to pay for our now moment, if you like. But if you think about it, you have 2,000 and you're giving every pound a purpose, and you know what you're doing with your money. This is why what we do is so powerful. When we start giving that attention to where we're spending our money, we become really aware, and that 2,000 becomes really impactful and might go from being 2.5 to 2. You then all of a sudden, if you're earning 2.5, you might have 500 left over. Therefore, you're going, okay, well, I need to have, if I need to have 3 months, I need to have £6,000 in cash. I don't have that. Oh, well, I'm going to put all my money in cash. I believe that is your asset allocation model really can help. I think, if you could put more of it, that surplus in cash, but some of it in your investments, you are therefore asset allocating as you are investing, some into cash to build up that emergency fund, because we don't want to be over savers and get just used to just saving and squirreling and avoiding risk. We're then like giving some of that money into to the stock market, into our investment ISA, our lifetime ISA, our pension, whatever it is that we are investing into to preserve the value. Because let's face it, the emergency fund might never be needed. So that's why we don't want to put all of our money out of fear of needing something into cash, because that cash ultimately loses value over time, even when it's in cash, right? So it is an emergency fund. And it is why we still need to go out and try and find the best cash rates when we're doing asset allocation at this basic level. And this is why I think it's so great, because we are investors from the moment we are trading our time for money to bring it into our bank account, and we decide what to do with it. And that's really powerful, because everything that we purchase, from our Apple phones to whether we go, well, I'm going to go and put £50 into a stock investment, or I'm going to put the rest into a savings account, all of this is asset allocation.
That's right. Yeah, that's right.
So,
I think just one thing that popped up in my head there, and there's everyone in different situations, right? Some people are starting off and trying to
yeah,
save. Some people have got a chunk of cash and they can
yeah,
afford to put a year's worth of expenditure away. And it's very
yeah.
easy to say, yeah, just put a year's away or put 2 years away. But some people can't do that. So everything has to be very unique to the individual person. It's just nothing further than that.
There's nothing
Um,
square peg, round hole in anything that we do, right, Adam?
no, no. But one, I can't think of a nice way to say mistake that I see a lot. What I think is a mistake, and very bluntly a mistake. So I'm not saying
Yeah.
that I'm
Love to
completely right
learn
with
lessons,
this.
Adam. Always.
Um, is that they inherit some money and it instantly goes on a car, a holiday, and the rest goes into the house. That's normally what happens. They're going to build an extension. They're going to put a conservatory on. They're going to do this. And um, and in a way, logically, this is just logically, money going into your house isn't you saving money. Now, your house may grow in value, which it probably will, um, but unless you move, you can never get that money out. It's very easy to put money into your house, new kitchen, which adds no value to your house, by the way, at all, because the first thing that someone does when they buy your house off you is to rip out your kitchen and put in the one that they like, right? Doesn't add any value. It takes value away. But all these extensions going onto your house, yeah, great. You've got all your money in your house, which is great if you're going to sell it at some point in the future. But most people don't want to move and they don't sell it. So you've got no savings again.
Yeah,
And
I
this is the problem. And it's to really, and the reason why people do that, I think, is because property is quite an easy concept to get your head round. It's all saying that property prices always go up and all this stuff. That's probably a misconception really of us, but we're so tied in the UK to property prices and property wealth that we can't see much else. And it's something that we all understand more than most other countries. So that's why it happens. But I would just say just try not to do that.
It's
I
because it
mean,
makes us
even
feel safe. It makes us feel safe that we've paid our mortgage off. And a lot of the time, especially in the economy that we're in, Adam, where we literally, a lot of us can't even afford to, and I speak to a lot of entrepreneurs, this cost of living crisis due to, oh, yes, inflation's come down today. I heard it on the news. Great, still inflation, right? We are literally unable to breathe after we've made money. And, we're killing ourselves getting taxed it left, right, and center as entrepreneurs. We're trying to do all of these amazing things for the world. And so one of the things that you think, if I just get rid of my mortgage, I'm going to feel safer. But and it is that safety. We are. we are conditioned, the mind is conditioned and primal, we are primally wanting to feel safe before anything else. So it is an automatic instinct as well for us to think that that's the right thing to do. But that is why we have to really have incredible conversations and look at it from a completely kind of um, blank canvas, unbiased perspective and go, okay, if we've got 100 grand, let's look at the options. This is why I love cash flow forecasting. This is why I love using cash flow forecasting technology. I don't give advice anymore, but I really help my clients to look at what will be the impact of this in a pictures perspective using cash flow forecasting technology. Because, when you do that, you actually see that, yes, you might save on the mortgage interest and you're not paying that mortgage off. Usually then you spend more, right? Because that's what our habits do. When we save something here, we spend more. But if you were to invest that and still have a mortgage, you'd invest it to it probably likely earn more in an investment, even if that was another property that's an investment property like a buy to let. That is that is a different asset. That's asset allocation, right? You really think carefully, and Adam has got such a point, and this isn't just an inheritance, it's if you're selling your business, if you just get a lump sum into your business, um what you do with it really matters. And we automatically often want to clear debt. And yeah, there's some debts we shouldn't have, like credit cards that have high interests. It doesn't often make sense to be paying 29.99% to someone, because it's really hard for even the stock market to create returns that are going to beat that, right? But when we're looking at kind of mortgage rates and kind of those things, we shouldn't be driven by the fear or kind of what we think we should do. We should really take a really important look at that, like the options. And again, it's asset allocation all the way. This is why I knew today's talk was, when I was sat getting out of bed this morning and I'm like thinking about you this morning, going, Adam's today. I was like, asset allocation is the way that I kind of want to focus on, because it just really helps us to kind of really understand what investing is, what we're trying to do, where we're trying to get to, and kind of create that knowledge around it. We're getting towards the end of things. I can't believe we're not meant to talk for this long, Adam. We're meant to
I
do
know.
45 minutes and tell people to come into the Star Portal to learn more from you. I think you've gifted so much knowledge today. Before we do dive into this last comment, I will just say, if anyone wants to learn more from Adam, the Star Portal that I run, which has a monthly investment circle, it has a portal all about my teachings of investing, of understanding investing. So there's videos. I go live weekly in a Facebook community, and there's a monthly live call. Adam will be coming into the live call in May, and you'll be able to ask Adam anything. That's the whole purpose. It's £8 a month, and you get 1 month free with start 1 month at the checkout. So please come into the Star Portal. It's just there to help you to become an empowered investor in whatever you want to invest in, from time, energy, money, entrepreneurship, everything, the stock market, gold, everything. So we talk about all different things within there. To finish, Adam, and I know you might have some things on just what I've just spoken about there, is I'm really curious as to whether you think we are heading towards maybe a hyper inflationary market, because I'm hearing on the grapevine that inflation is looking tricky. We're already squeezed in this country. What are you thinking in house about the kind of where inflation is moving?
Yeah.
Inflation is how poor are we going to get?
Yeah, so your inflation's going to be higher in the next 10 years than it was in the last 10 years. Okay. And we're used to inflation at 1.5 to 2%, mostly with goods inflation coming down. Goods is the things you buy, products. and that's actually been deflationary over the last few decades before that, because of globalization and zero tariffs and things like that. And in the future, we should be expecting far more, like say 3% or so, which does make a difference when you add it up over 10 years or so.
Yeah.
It's never smooth. It's never 3% every year. It always goes up and down a little bit. Tariffs is going to push inflation up by 1.5%. But normally that's a one-time thing. So it will push everything up, and then it will
Level
and then
out.
it will stop, because remember, inflation is just a yearly. It rolls on a year basically. So once you lose that spike, it's out of the yearly data, and then it'll go back down to 3. But it doesn't mean prices go down. Prices are continually going up. Inflation is the rate of prices going up. Unless you get deflation, but inflation is just going up. So it is going to be slightly higher than what we're used to. And I think we're getting back to how we were a number of decades ago, where you went out for a meal and that was a treat, you know. And we're getting
Yeah.
to the point now where it's the same, because you're like, well, that's expensive,
Yeah.
that's expensive, when taking everyone out. So we probably got used to a world where everything was quite cheap, and cheaper than what we should have really had. So it will be transitory, or it should be, this tariff inflation. It depends who takes the hit of it. Is it the consumer? Is it the seller? Is it the supplier, who takes the hit of the tariffs, and where that's spread? And they'll be different for different companies and different for different sectors and regions and things like that. But we just need to know that we don't know. I think that's
Yeah.
one
No.
thing.
Yeah.
It's just stay humble. Um, stay humble. Things can change very quickly.
You
And
just reminded me of a song. Wasn't there a song like Lee Humble on Radio One? And what's it? There's some sort of rap about that. And
right. I
sometimes
see.
when you speak, my head goes off on some sort of tangent.
Yeah,
Tariffs are like Trump's obviously saying that he wants to put America first, and he's going to charge tariffs on non-US made goods that go into the US, right? Because he wants goods that can be made in the US to be sold at a better price within the US, right? Is that what you're meaning by tariffs?
yeah. So it's a tax on importers,
Yeah,
basically. So
yeah.
and it's how that extra, and so the average tariff for the last few years has been pretty much zero, and now it's going to about 20%, even with these sort of reductions and things like that, because China's such a big part of imports into the US, that it's about 20% tariff, which is quite high, going back to early 1900s. So and someone has to pay for that, and normally it's in tax, and they can pass it on to the consumer. So when you're buying goods, say in Amazon, things will go up a bit. They're pretty good prices anyway. So and it's whether people try to change their supply chains and move things in other directions into different
Yeah.
global regions and stuff. So there's a lot of uncertainty. It'll be down to individual companies. This will make things a bit more sluggish. They'll hurt growth a little bit in terms of GDP. It will make inflation slightly higher, but at the moment, it doesn't seem like we're going to go into this depression, which everyone keeps saying is very similar to the 20s. It is not the same as the Great Depression in the 20s. This is not the reason. Tariffs were not the reason for that. The lowering of tariffs were not the reasons for that. Okay, there was a lot of different reasons. So it's not.
I've seen a lot of depression from people generally, right? The feelings are, it's just a lot of people are getting tired
Yeah,
because it's felt hard for so long. I saw a post today on LinkedIn from a friend, wanting to leave the UK, and I've seen people leaving the UK to go to better economies that feel easier. They have the freedom to leave. I'm not gonna lie, sometimes I'm like, can I come with you? because I've got kids and I've got a lot. I feel like I can't just up and leave, but a lot of people are looking at really uprooting their entire families to leave the UK because the UK economy, we've just not been investing. Go back, sorry, not just to add this on at the end, but when you look at the US, their dividend yield is so much lower than UK companies because they reinvest massively and it's hard. Like we talk about, having that stable, it looks bad if you start reducing dividends. And the UK has been really hesitant to invest. And I think it's been to the detriment of the UK, really,
Yeah,
generally, that we haven't invested enough in our own country, and we've imported so much. This tariff is going to hurt us, and it is going to feel it. But I really want to kind of like switch the energy here and say that is why we need entrepreneurs in this country to create things in UK soil, to really, create things here like Trump, UK first, putting ourselves out there first, wherever you are in the world, just doing it in your own economies and trading with your own connections. It felt amazing being at Business Fest Southwest recently. You should have come, Adam. You
yeah,
know,
I know.
um,
Brilliant.
next year, I'm speaking to Jim. That was who Jamie was the funny when we started going on the for the show today. Putting roots down in our own place to actually start doing more things, getting more humble, because we don't need to always be doing all these things. We can actually start to become human again. And I know that's a big thing about what I believe in. This is all about, and I think it is creating a shift in the world. I think some of the things that are happening needs to happen. I think that's what you were alluding to. We've had, years of feeling things were cheap because of all the things. Actually, is this where we should be? We should actually be more humble and kind of feeling this pain to kind of come back to ourselves and see a correction, not just in the stock market, but in life generally.
Yeah. Yeah, when it's almost like when things get dirty, we get a new one when actually we could just clean it, in
Oh,
terms of
100%.
products and stuff.
I've
Um,
started cleaning my own car, I actually have always loved cleaning my car. I used to go on the streets of London and clean my car with my bucket, looking like a mad woman because nobody else used to clean the car. But I always grew up in Bradford cleaning my car, and I used to take massive pride in doing it as well. So there
Excellent.
you go.
I think you're absolutely right. And I'll just note one thing, two things is that yeah, we need ambition. We need to educate kids in school about business. We
Yes.
need to give them the ambition to do whatever they want to do, and we need to lower the barriers of entry to starting a business. They're the sort of three things that we need to sort of start pushing, and that's it.
Yeah, and keeping people in entrepreneurship, because the barriers of getting in are hard, but also it's sometimes it's hard staying in. It's like you're constantly feeling like you're being hit across the face with a wet fish. What's coming next? And then you start to think, well, I'm not going to invest because what if? So that's when that fear comes in.
Mm.
Thank you, Adam, for your time today. As always, it's just an absolute joy to see your face and to have you here. If you do want to work with Adam, Adam's links are in the notes. If you want to reach out to Adam, it's Adam Brewer on LinkedIn. And if you're going to work with any investment manager, you need to work with Adam. He's just incredible, and you can speak to Adam in the Star Portal. The links are all in the About section. £8 a month to come and hang out with Adam and I and my other wonderful experts with their 1 month free with Star 1 month. Thank you for coming on the show today, Adam.
Absolute pleasure,
See you.
always.